Money man Martin Lewis is joining us now to answer some of your questions. Morning, Martin. I know you're getting ready for your show tonight. It's a special on ITV1.
I am indeed. I'm writing the graphics right here as we talk. It's a big one. It's my summer special. I've got 2 hours worth of content to fit into an ITV hour, so it's going to be jammed with information. The lead subject, as people will know, an ITV hour is about 46 minutes. The lead subject is boosting your state pension. There is a massive deadline at the end of this tax year. This is probably the single most lucrative issue I talk about. For some people, it's worth tens or 20, 30,000 pounds even. Are you missing national insurance years? I'm going to take you through step by step what everybody aged under 73. If you're under 73, this is massively important. It could mean tens of thousands of pounds to you. Also, as it's summer, we'll be talking overseas travel, the cheapest way to get your euros, to get your dollars, to get your dong, which some people might be interested in getting too, plus travel insurance, car hire, all those extra things you need to be planning now in order to have more bang for your buck once you're on holiday. And I've got my news you can use with top savings and, free bank accounts that are willing to pay you cash. It is a must-watch show. Basically, it wasn't originally meant to be happening. I managed to persuade ITV that in the middle of a cost of living crisis, well, our series is normally October to March. We need a summer special because there's so much information to catch you up on. So don't miss it tonight at 8 o'clock ITV.
If anyone can fit it all in, it's you,
yes,
Martin.
Sure.
We believe in you. OK, this first one here is from Carol. She says, I'm 66 years old and thinking about paying voluntary national insurance to boost my pension, but I'm not sure whether it's actually worth doing. I currently have 30 years, but I've seen elsewhere that it says 35 years. Please, could you tell me how many full years I actually need?
I can't tell you because it isn't a simple fact. I tend to use, and this is what the show is about tonight, so please watch the show. I tend to use the phrase, you need 35-ish years, 35-ish, with the emphasis on the ish. For some people, it's 43. For many, it's 35. There are lots of different numbers. And that's why this is a delicate process. You need to know, because some people can get the missing years for free. Some people have to pay the missing years. Just to put it in context, the most you're going to pay for a missing year is 800 quid, and that will typically gain you £5,400 or more. So it's really worth doing, but we don't want you spending £800 unnecessarily. So there are ways to find out. You go online, you do the checks, but I think rather than me going through it now, because I've got proper time to do it tonight, and we've got lots of questions to go through, watch the show tonight. I'll be doing it step by step. It's really important you get this right, because the deadline is the 5th of April next year.
We talked about that last week as well. It's an interesting thing, and absolutely. Carol, watch the show, because Martin will have more information there. Let's talk about Janet now, who's been in touch with us. She wants to check for gaps in her tax pension, Martin. She's registered as blind. Who can she speak to about checking whether I have any gaps in my tax pension, she's asking?
I think that's the same subject yet again. I suspect because people have seen the promos for me doing the show tonight, they're asking questions about it via this morning. If you're blind, I don't know whether you can use a screen reader, and I don't know how well the screen readers will work if you're going online, because you can check the gaps on gov.uk, which is part of the process. You can also check your state pension prediction on gov.uk. If using a screen reader is difficult for you, and that's not something you can do, well, you can also call up. If you are below state pension age, then you call up the Future Pension Centre. If you are state pension age or above, then you call up the Pension Service. Now, do me a favour, those watching. You should only really be calling those services at the end of the process if you've done all the other checks. Those phone lines take a lot of time on hold. It isn't worth calling unless you've done the checks. Obviously, for someone who's blind and doesn't have any other access, you have to call from the start point. But don't clog them up now. Again, and I wasn't intending to do it this to plug, but this is what I'll be going through tonight. What are all the checks? It's going to take me about 20 minutes. I'm doing it step by step. Okay. Have your notepad and your pen ready. But obviously, if you don't have access to the internet, then you're going to need to make the calls now.
All right.
OK. Next up, Joe. He's talking about car insurance. I'm a named driver on my wife's car insurance policy. I've had an increase in price on the new policy for my own vehicle as a direct result of filing a no-fault claim on my wife's policy. Both of us are insured with the same company, and I've been told she will also be affected by a similar increase when her insurance needs to be renewed. Why is this allowed? Surely all costs should be reclaimed by the offending party.
This isn't about costs. So the costs are totally separate. This is about the way that insurance works. Insurance is priced based on risk. So they have these massive statistical calculations that look at an individual, all this different data on them, and they plug that in and say, what is the risk? Now, frustrating and annoying as it is, the fact you have had an accident and there is a claim going through, even though it wasn't your fault, changes the risk calculation of you and your wife as a customer for car insurance. So effectively, I mean, oversimplifying, what they're saying is, well, the fact that you drive in places where you're likely to have an accident means that you are potentially a higher risk of having another accident in future. Therefore, we're going to put your cost up. And that is what you are suffering from. And it is absolutely teeth-grindingly frustrating, but that's the way it works. I mean, car insurance is counter-logical in some ways until you think about it. It's why, for example, if you've got a young driver, adding a second person, so who might legitimately drive the car, say a mum or dad, onto the policy can actually decrease rather than increase the cost because it brings down the average risk. It's why sometimes fully comprehensive can be cheaper than third party, because the type of people who select fully comprehensive policies can be deemed to be a lower risk than the type of people who select third party. So if you want the cheapest, you should always check fully comprehensive. It's also the reason I say, if you're getting quotes for your new car insurance, you want to do it roughly around 23 days before the renewal date. 21 to 27 is fine. Earlier or later, you will likely have higher quotes because the people who leave getting their quotes to the last minute are actuarially deemed to be a higher risk, and therefore they pay more. So changing your habit and getting your quote around 23 days before your renewal date, so this is quotes from new companies, not your existing company, because that's just a renewal quote, can actually, in some cases, take a third or a half off the quote. It doesn't always work, but I have had tens of thousands of people saying it works for me. So car insurance is, you have to get in your head, it's all about how making your behaviour go in a way that makes the car insurer see you a lower risk.
I remember listening to you and Nihal doing this on Radio 5 and my mind boggling with the complexity of it, but you talk them through brilliantly, so hopefully, Joe, that's some help. We've only got a minute left, Martin. So Joanne says, what should I do with my redundancy package? I've been made redundant after 20 years, a large redundancy of about £40,000. I'm wondering, is it best to pay off my mortgage or put this into a savings account and earn interest instead? As she says, she's 40 years old, so she's going to continue to work as soon as she gets a new job.
OK, so the first thing to say is I'm assuming that you have no early mortgage redemption penalties, which would probably kibosh it. It's very simple. If your mortgage rate is higher than the amount that you can earn in savings, then mathematically it's generally worth paying off the mortgage. If the savings rate is higher than the mortgage rate, it's worth saving. So as long as there are no penalties, whichever is the higher rate, because effectively paying off the mortgage is a bit like saving in reverse. The only thing I'd really, so have a look at that, speak to a mortgage broker as well. The one thing I would really say is always keep a cash emergency fund in savings, 3 to 6 months worth of bills. If you were to lose your job and have no income, that would keep you going for 3 to 6 months. Don't pay that off the mortgage, because if you do, the fact that you've overpaid doesn't mean you can then borrow it back. You could still be in arrears. So if you're going to overpay the mortgage, which for many people is the right thing to do, it's a really risk-free way when you're comparing it to savings, always keep a cash emergency fund behind and do check there are no penalties, early
rainy day money.
Penalties.
Yes,
as my mum would say, rainy day money.
Martin, thank you very much. Remind us what time the show's tonight.
Thank you. 8 p.m. tonight, give it a watch.
It's going to be busy, and obviously you're going to start, there's important questions that we've had that Martin will be able to offer you more detail on this evening for Carol and Janet specifically. Great to see you, mate. Thanks for joining us.
Oh, hello. Thank you for visiting our This Morning YouTube channel. We upload tons of new content every single day. So hit the subscribe button, like all the videos, and don't miss out. We'll see you in the morning.